Afternoon and welcome to our program titled The McCarran-Ferguson Act, 79 Years On, exploring its history, role, and relevance. I'm Frank Tomasello, Executive Director of the Institute's Griffith Foundation and moderator for today's session. In just a moment, I will introduce our presenter, but first, some housekeeping items of note for our attendees. All participants are in listen-only mode. However, we encourage you to ask questions using the Q&A feature in the webinar interface. To make use of the feature, simply type your question in the space provided and click send. Note that your comments will not be seen by other attendees. I will review all incoming questions and will pose as many as time permits during the final segment of our session, which will be devoted to discussion and Q&A. After today's presentation, you'll receive a brief survey. Please take a moment to provide your feedback. Your comments are valuable as we seek to meet your needs with Griffith Foundation offerings. In keeping with the mission of the Institute's Griffith Foundation, today's program is strictly educational in nature. It will not support a position on any issues. Calendar year 2024 marks the 79th anniversary of the enactment of the McCarran-Ferguson Act, landmark legislation undergirding our system of state-based insurance regulation here in the United States. And joining me today to explore the history, the role, the relevance of the Act is Harold Weston, Clinical Associate Professor and Distinguished Chair in Risk Management and Insurance, Greenberg School of Risk Science at Georgia State University. To learn more about Professor Weston's background and his research interests, we invite you to visit robinson.gsu.edu. Professor Weston, welcome to our microphones. We have significant ground to cover. We have limited time to do so. Where would you like to begin?
Well, more than 79 years ago is probably a good place, because to make sense of this act, we need to understand how it came to be and why we even deal with regulating insurance. So glad to be here. Thank you for the introduction. 79 years is an odd number of years to count. I mean, shouldn't it be 80 or 75? But I'm glad to do this today, and we can come back in another 11 years or so. So I think underpinning all of this is why we even regulate. There are so many other businesses that are regulated to a much lesser extent. I would not say unregulated, because in all states there are laws against unfair business practices and antitrust issues. So there's always some regulation in place, but insurance is much more regulated than others. It is a financial services product and financial services companies. And so, like banks, they are very heavily regulated. Insurance has been said many a time to be looking towards the public interest and the common welfare, or the public welfare, however you want to put it that way. Public interest is the word we see in most of the cases and in the statutes. And that's because it's hard for consumers to make sense of insurance, let alone many other products. And something that I think is always important to remember dealing with insurance, and that is we sell promises. We don't sell goods or services. This is the only business in which people send money to the insurance company and they basically get nothing back except a long contract that they don't read and they don't understand. And it's not until some future contingent loss happens that everybody finds out if the insurance company is solvent and reliable to pay for the loss that they have contracted to pay for within the bounds of coverage. And so I put here a quote from a couple of good authors on this subject, that the regulation is to make sure that the insurers are there in the future. As I say, we sell promises, not goods or services, and the insured needs to be assured that in the future, when that contingency happens, that loss happens, whether liability or property, the insurer is there to pay. And it's on that basis that regulation started a long time ago. What's generally credited as the first state regulation is 1852, and many states quickly enacted regulations after that. Here's a helpful chart I took from the Insurance Information Institute that gives an idea of how regulations were coming into being on this kind of thing. Part of the problem is that insurers like to underprice and take money in and were not available when losses would hit. That became a real problem because people paid money for something in the future, and the future came with nothing there to deliver on that kind of thing. Let me digress just a bit on this point, because to make sense of insurance regulation, we want to put some sense of that into the NAIC, which started in 1871 under a different name, the National Convention of Insurance Commissioners, and they changed their name in 1910 or 1936 to the NAIC as we know it. This is important because it facilitated some similarity and consistency in regulation state by state. The NAIC is I believe, a nonprofit. It's an association of insurance commissioners and their staffs that convenes their own hearings and meetings. I'll talk more about this later, and does their own analysis to facilitate commissioners across the states to help regulate these large businesses. The other thing to put in mind as we talk about the McCarran-Ferguson Act is, what is it we were regulating? Well, we're regulating rates, and there's a long history of that. Why do we regulate rates? Well, insurance is this funny business where we take cash in and we may not pay it out for years. And therefore, it's important that the insurers make enough money to be properly solvent for the future to pay any future losses, but not make so much money that they're stiffing their customers. The other thing to bear in mind is that large fires, such as happened in Chicago and Boston, 1871, 1872, we can even look beyond that to the San Francisco fire of 1906. These are the kinds of major disasters that took down many an insurance company. And here I'm focusing on the property casualty companies, the fire companies. Because often in those days, the insurers were regional, local. They insured the local areas for businesses nearby, which meant that when one wooden building caught on fire, the whole block or the whole city went down. There was not that much interstate type of distribution of loss. That came later as many other insurers failed and their survivors realized they needed to be writing across state lines or across the state to distribute the kinds of losses that would allow them to survive. To deal with the problems of inadequate rate, which were not always as sophisticatedly calculated as we would do today, underwriting bureaus were established that could develop rates that would be adopted by the insurers to make sure that they were charging enough money to have enough money in the future to pay for the future losses. These often became rate compacts, and to avoid destructive competition, these became mandatory rates. And it was this kind of mandatory rate usage that led to the need for regulation to make sure that now at this point the rates were adequate, but oftentimes the insureds were perhaps being charged too much. And so some balance is needed then to make sure that the insurer makes enough money, but not so much as to harm the consumer. To deal with this, states started to enact their own antitrust or anti-compact statutes to prevent what we would easily call collusion among insurers. Well, if I charge this, you're all going to charge the same thing. And the bureaus had that function to make sure that all the agents who at that time had a lot more authority to underwrite, and the insurers were following the approved rates. So collusion was a word that was used at that time and was pretty much understood to be what was often happening among insurers. Look too at these timelines. 1895, we start to see this. Missouri was actually one of the leaders in this. 1912, and within that period, the federal government was now dealing with antitrust statutes, the Sherman Antitrust Act and the Clayton Antitrust Act. And so this was in the air of both state and federal concerns to make sure that large businesses were not colluding and conspiring against the public interest by overcharging for acts. We want competition, we want protection, but we have to figure out the balance on that. And so this led some years later to rate regulation statutes and the Department of Justice finding that half the states left the public at what it said, quote, were the mercy of the rate bureaus. Whatever the rate bureaus said was the rate to be charged by the insurer, this was the rate that they were going to charge, no deviation from that. I should fill in just a bit on this, that most of these rates pertain to fire insurance, meaning loss of your building to fire. There was less so for other types of perils. Those were just starting to come in the early 20th century, and not much on liability that we see about in the history at this point. Automobiles were also first coming in the early 1900s, and there were also liability and property for the automobile insurance market. But primarily what we see are fire rates that are under dispute by the state regulators. Well, one of the questions that we have to deal with for McCarran Ferguson that arose at least twice to the U.S. Supreme Court is whether or not insurance constitutes commerce sufficient to be regulated as interstate commerce under the U.S. Constitution. If it is interstate commerce, it's then able to be regulated by the U.S. government. And if it's not commerce, then it stays with the states. And so in 1868, a case involving an insurance agent who was required to post a bond, as was then typical for control of agents. The case went up to the U.S. Supreme Court, Paul versus Virginia, to hold that no, insurance is not commerce. There's no goods being delivered, there's no stocks being sold, there's nothing that anything looks like commerce other than a contract. And we all know contracts are not commerce, basically said the court. At least with equities, bills of lading, something gets delivered. But this is, as I said at the beginning, the nature of insurance, that we sell promises, we don't actually deliver anything else. So Paul versus Virginia was the case that laid everything back with the states, or affirmed that the states were the right place to regulate insurance, being that there was no commerce involved and nothing for the federal government to touch. Sounds like the right decision, until we think about the fact that insurers are actually in other states with agents appointed in different states, with money flowing back to the insurers in those first states to be invested in Wall Street or Philadelphia or Boston markets, in all sorts of other things. And so what's not commerce because a good or service is not being delivered is very much interstate because of all the money sloshing back and forth across state lines. Well, the insurance industry, as it grew, didn't like having all these regulators. And it turns out, as we look through the history, that there were quite a number of initiatives to try and move the regulation to the U.S. Congress. the insurers were bothered by what we would now call inefficiency of having to comply with all these state regulations that were not always in harmony, despite the NAIC being early in this. There were also all the taxes to pay at the various states, and insurers, like most businesses, don't like to pay taxes. So they were thinking, let's get this to the US Congress. That will make more economic sense in terms of one place to have regulations for our multi-state business. And so we see quite a few of these initiatives going on here. I've put them in yellow highlight. And then, of course, the case that flipped everything to interstate commerce. As we look through that history, Senator Dryden, noted here, delivered a few lectures on this, collected in a book, addresses and papers on life insurance and other subjects by Senator John Dryden, who was also the president of the Prudential Life Insurance Company of America. In those days, senators were appointed by legislatures. They were not popularly elected. So we can guess how it is that someone worth $50 million, as we have been able to find online, was able to get himself appointed as a senator. Anyway, he had given a couple of speeches available in this book, in which he urged that Congress take over the regulation of insurance. He was not the only one. As you saw on the prior slide, lots of others were making that effort, but he was perhaps the one who made the clearest declarations of this through speeches and given his prominence in the insurance industry. Let me come back to, one second here. Well, despite all of these initiatives to try and move things to the US Congress for insurance regulation, it was still being regulated by the states. And in the early 1940s, Missouri was really agitating against the rating bureaus and the compacts among the insurers that were maintaining all of these rates. And so Missouri then pushed for the US Department of Justice to have a look at this. And in those vigorous days of antitrust enforcement, the Department of Justice decided to bring a lawsuit against the Southeast Underwriters Association, one of the several regional rating bureaus in the US. Despite all the prior talk about whether it ought to be at the state or the federal level for regulation, the Department of Justice came down with a criminal indictment against every insurance company that was subscribing to the Southeast Underwriters Association rating manuals. As pointed out by others, this could have been done in any other parts of the US. There were Northeastern underwriters, Pacific, Northwestern. Just so happened, for reasons that I can't find and may not matter, that was done to the Southeast underwriters here in my state of Georgia to take on this question. And in this decision, the court decided, well, let's have another look at this Paul versus Virginia case, because this really matters. And what the court decided was, well, Paul versus Virginia is no longer right. It really is interstate commerce. It really is commerce among the states and between the states, and therefore Congress, having authority by the Commerce Clause, should be regulating this. As the court said, let me just pull this up here for us. It is interstate commerce subject to regulation by Congress to carry lottery tickets from state to state, to transport a woman from Louisiana to Texas in a common carrier, to carry across a state line in a private automobile 5 quarts of whiskey intended for consumption, to drive a stolen automobile from Iowa to South Dakota. Diseased cattle ranging from Georgia and Florida are in commerce, and so on and so on. And so in that context, the court decided insurance is interstate. The prior restriction that commerce was only some real good or service to be delivered no longer made sense. It was a controversial decision. Even among the court, the dissenters said, well, that may be right, but Congress has had a few opportunities to take this over, as we can see by these prior initiatives. And given those opportunities, maybe we shouldn't be deciding this question. Maybe we should just let Congress decide to take it over. This should not be a court question. This, by the way, is exactly the kind of thing that showed up, 60 years later in the Affordable Care Act on the debate of whether or not Congress could regulate medical insurers and set up exchanges and all these other things. So this question, decided in 1944, has remained an active one even for the more current times, in our case dealing with medical insurance. Well, it turned out, despite all the efforts made over the years by insurers to try and move regulation to the federal level, getting hit with a criminal indictment was not what they had in mind. And the states definitely did not like the idea that they were about to lose regulating all of these insurers, giving up a lot of government jobs, and losing a lot of tax money that came about with the insurance business. And so there was a big effort by the states and by the insurers to try and reverse the decision of U.S. versus Southeastern Underwriting Association. Very quickly, bills were being introduced in the House and the Senate. The NAIC, representing collectively the state departments of insurance, also crafted a bill which itself became the McCarran-Ferguson Act. And Roosevelt was happy to sign this to move everything right back to where it had been with the states. The one proviso of this was that there was a condition to keep it with the states, that the states would have to deal with rate regulation. And these compacts would no longer be allowed as enforcing a type of required minimum type of premium. So it mostly wound up being where they wanted eventually, although where they wanted had not been this place 30 years before. They wanted to move it to the federal. And yet here they were, when confronted with a criminal indictment, decided, well, maybe we'll go right back to the states where we know what we're dealing with. I think we can also say, although I've not seen this in the history, this was the time of World War II. And despite the very vigorous efforts to deal with antitrust and the Depression in the prior years, and the vigorous initiatives of the Roosevelt administrations to deal with those multiple calamities, I have a feeling Congress was tired and didn't want to take up the banner of regulating insurance, given that there were, I guess at that time, about 48 regulators already in place. It's a short statute. It's only a few sections long. It doesn't really say that much. Didn't have to say much, because it basically was reversing the US Supreme Court, although technically it wasn't a reversal. They were simply declining to exercise the authority that they had. And so, as you can see here, Congress hereby declares the continued regulation and taxation by the states is in the public interest, and silence on the part of Congress shall not be construed to impose any barrier to the regulation of such business by the states. So continued regulation had been regulated by the states. Congress was going to just leave it at that going on. As I say, not much more is in the statute, just a couple of sections. The next section, 1012, subject to the laws of several states which relate to the regulation or taxation, and that there shall be no federal regulation except as pertains to antitrust, or a few other things that Congress might specifically impose. So Congress basically reserved the right to take it back, and Congress sort of created an automatic retrieval of legislation as long as the states actually imposed rate regulation. Not until a couple of years ago was a new section added dealing with health insurers, a part that's not exactly relevant to what I want to talk about today in terms of how we got to state regulation for insurance. But we can talk a little bit about that, Frank, at the end as to what McCarran-Ferguson means for different lines of insurance, property casualty, health, or otherwise. So let's go back to why we're regulating at all, because this underpins who's going to regulate. What we are regulating are rates, solvency, and market conduct. Well, the rate part I've talked about before. The rates have to be adequate to make sure that these insurers are there in the future to pay the claims. In the case of fire insurers, that's not very far in the future. We call that sort of short tail. That is, the fire happens in this policy period. We know when it happens. We know we're going to pay it pretty soon. Liability losses can take years to develop. Life insurance can take 30, 40, 50 years until the policy is paid out. And so the need to make sure that the rates are adequate to support those losses is imperative. Obviously, a well-managed company will be doing that, but every company is subject to the temptations of early dividends and early profits against long-term solvency. We want to make sure that rates are not excessive, that's in the public interest, and not unfairly discriminatory. An old phrase dealing with making sure that everybody gets charged the right rate for their exposure, but one which has developed more meanings to it in the past 50, 60 years to make sure there's no race-based or other similar discriminatory pricing. We expect insurance to be priced with discrimination. That is to say, different risk profiles should be charged different rates. Higher risks should be charged more. Lower risks should be charged less. But they have to be on objective bases to make sure that we have things we can say objectively will affect the risk classification. Other types of classifications are not permitted. That becomes ever harder these days as more questions arise as to how this works and how it is to be applied. In fact, in the past few years, the very question of whether insurance on mortgages is affecting things for Fair Credit Reporting Act and for housing discrimination. Making sure the rates are adequate goes to the second point, making sure the insurers are solvent. And so the states are responsible to make sure that the insurers licensed, or I should say domesticated in their states, meet the solvency requirements for their expected future losses. Under the NAIC, which has model standards for this, the state where that insurer is incorporated will be examined to make sure that its assets meet the proper standards, the proper level, that they have the right level of assets and mix of assets to assure their future solvency. And there are model laws on exactly how much capital is required and what kinds of capital. We often call this Tier 1 and Tier 2 under the risk-based capital requirements. Oftentimes people think, perhaps because they've seen too much or too little of Warren Buffett, you take money from the premium money, you throw it in the stock market and make a lot of money. In fact, insurers are highly regulated on their investments. Most of the investments must be in high quality bonds. Only 25% of the investments in a property casualty company can be in stock, only 20% in a life insurance company can be in stock. So there's not much gambling going on in the stock market for well-regulated insurance companies. And financial reporting. After all, the regulators need to make sure that they can match up the financial statements not only according to GAAP, the recognized standard for accounting, but based upon their own more conservative standard, what we call statutory accounting processes. The third area is market conduct, to make sure that policy forms are readable, that they're fair, that they meet statutory minimums as to coverage, whether it's fire insurance or otherwise, that insurers can't cancel a policy midterm except for allowed reasons, that their representations in their marketing are done as allowed and not otherwise. We've seen problems over the years with life insurance and variable annuities and replacement of life insurance. These are all regulated to prevent the kinds of abuses that have arisen, and others in the property casualty world, to make sure that claims are handled in a fair and expeditious way. There are statutes on this, and state-based relief in most states for what we call bad faith, where insurer has wrongfully denied benefits under a policy. To deal with that fairness issue, and I would also say privacy, because the insurance world was actually dealing with privacy way before others were. Well, why are we regulating? For the reasons I've said, to make sure that the insurers will be around to pay the claims, to make sure that they get a fair return, but not a gross return on their premiums, and to protect consumers and small businesses. Large businesses really don't need the protection. In fact, we exempt them from many of these protections. After all, many large businesses are larger than the insurers they buy from. They often create their own specific insurance policies, and this is really a matter of contract negotiation between the biggest ones. But it's the other folks who need the protection. Is state regulation working? Mostly. The NAIC continues to put out model laws. I mentioned privacy, and I want to point out that although that has become a very important and current topic in these past 10 years, with now 15 states enacting privacy laws, the insurance industry had this back in 1992, a full 8 years before Gramm-Leach-Bliley came up with requiring privacy in the financial services sector. That statute, the Insurance Information Privacy Protection Act, has been adopted in, I think, about 20 states. Not in all, but in those states where it's been enacted, it has not been a problem to business. More current things that state regulators are looking at are predictive modeling, what we otherwise call data analytics, sort of a variation of actuarial studies to try and figure out what are future losses and therefore future prices to use. We use past losses to guide our decisions for rates, but past losses are not always perfect. Things change, trends evolve, and so we need to try and figure out what the future is to adjust the past losses to set the rates. Artificial intelligence, the latest area that's just starting to be addressed. And here, by the way, the NAIC has come out with a new model act to deal with these very kinds of things after several years of study. Some of the states have led in terms of cybersecurity for insurers, New York State being the most noteworthy. And as a large state with a long history of insurance regulation, what New York says on cybersecurity will pretty much be applied, at least informally, by all insurers in most states. Certainly anyone dealing with New York State insurance. The NAIC also came out with a model law on data security. And Colorado and New York, just to mention a couple, have already issued regulations, Colorado based on a statute, for the use of by insurers of external data in underwriting, basically what they can take or not take from data brokers whose information is often subject to all sorts of disclaimers that it may not be reliable. That's a distinction with the Fair Credit Reporting Act and credit reporting agencies, a topic beyond my discussion today. Here's a list of some of the things the NAIC has been studying, taken from their current webpage. A little blurry, I understand, but you'll have the PowerPoints, and you can go to the NAIC.org webpage and see the kinds of topics that they are working on, from cybersecurity, big data and artificial intelligence, financial analysis, producer licensing. And although I've talked mostly about property casualty, somewhat about life, there's also title insurance, health insurance, long-term care, and pet insurance has been a big topic for the NAIC, among many others that they've been working on. The feds have not stayed entirely away from this. Let me list just a few of the federal statutes that pertain to insurance. The Violent Crime Control and Law Enforcement Act covered many, many things and had a couple of provisions dealing with insurance listed here. I can only wonder what legislator was bothered by his insurance agent to think he needed to include this provision in a federal law dealing with all sorts of other crimes. Medical records are subject to privacy by federal law, what we call HIPAA, spread out over many statutes. So far as we're concerned here, this goes to privacy, and it's probably the strictest privacy law we have on insurance and perhaps many other types of areas. The Risk Retention Act of 1986 dealt with the ability of insureds to join together to obtain and create their own liability insurance during what was then the tort liability crisis of the 1980s, when insurers were being hit with so many claims because of so many tort suits against their insureds, they were backing away from the market. And then the Financial Services Reform Act of Gramm-Leach-Bliley brought about some more statutes pertaining to insurance and allowing for the consolidation of insurers, banks, and other financial service companies together. Dodd-Frank, 2008, I think it was, established the Federal Insurance Office to do its own studies of insurance. It has no regulatory authority. It is only a data collection and analysis facility, which has often led to questions of what really it's doing and whether you really have to follow them. But it arises from the need to determine that insurers as financial services companies are not systemically dangerous to the financial service. As it is, the FIO has been collecting information on a few topics such as cybersecurity and climate issues, but they are so far only allowed to collect information and prepare reports. I'll mention just briefly that our state-based regulatory framework is unique. The European Union does not do this. European insurers cannot understand how we've come up with this system. They have the EU regulation that then gets adopted by the various states, nation states at that point. And as to what the future should be, well, that's going to be a topic for many people to take up. My few remarks on that would be what we have may be a little clunky, but it's been working. It reflects what was a deal made in 1944 to keep it with the states. There have been some efforts and initiatives over the years to have an optional federal charter for insurance, just as there are federally chartered banks. And whether that should ever make sense is a bigger topic than we have time to deal with today. So that's my presentation on the history and relevance within our time. Frank, I know we probably have some questions, and you may have some too.
Professor Weston, thank you very much. An enlightening presentation. We'll jump into some discussion and some Q&A. And again, a reminder to folks participating, if you have a question you'd like to submit, you may do so using the Q&A box within the webinar interface. We'll monitor those and present those as time permits here. Professor Weston, during your presentation, you spoke a bit just a moment or two ago about the Dodd-Frank Act. You spoke of FIO, the Federal Insurance Office. And earlier this month, FIO announced a first-of-its-kind collaboration with state insurance regulators and with the NAIC, whereby state and federal organs are coordinating efforts on homeowners insurance data collection. The goal, as I understand it, is helping all to better understand the impact of climate-related financial risk on the insurers and, by extension, insureds. In fact, in early March, via press release on the Department of Treasury's website, Treasury Secretary Janet Yellen was quoted as saying, I'll quote her here, "I'm pleased that the Federal Insurance Office, state insurance regulators, and the NAIC are collaborating on this important data collection. Analysis of homeowners insurance data is essential to understand the market impacts on consumers and helping policymakers across the country respond appropriately to the risks," end quote. Again, quoting Treasury Secretary Yellen. I'm curious, Professor Weston, can you speak to the significance of collaboration sort of through this lens of the McCarran framework and our state-based system that you just lectured on?
Well, I can address it as an outsider. I'm not on the inside between FIO and NAIC to know their details, and I've not talked with anybody about that, although I'd like to hear more from them directly over coffee or over a bourbon when you can get some better answers. I think it's important to coordinate, and I suspect one of the frustrations of insurers is having to answer what are referred to as data calls by the federal office, and then all the regulators and the NAIC's own data calls. So I think coordinating this certainly will benefit insurers and the offices that are trying to get this information and avoid duplication of things. There's so many things changing about insurance, or I should say the risks underpinning insurance, that the need to understand it and understand the ability of insurers to cope with it is important for all the regulators and for the Federal Insurance Office to do its job of assessing the financial health. Yes, the more coordination, probably the better.
Thank you, Professor. We have a member of the audience who asks for your thoughts on FSOC and its forays into insurance. Any comments there?
FSOC, help me make sure I know which one we're talking about on that one.
So the Financial Stability Oversight Council.
Oh, okay. Well, insurance, you know, the thing about insurance is it protects individuals and businesses. We have a guarantee fund in each state for losses that arise when insurers become insolvent. That's not always sufficient, but it is a start. It doesn't apply to surplus lines insurers, a whole different subject than we can get into here. So some policyholders may not be covered on that. The problem of financial stability arises from the systemically important, very large insurers. AIG was the poster child for this in the 2008 financial meltdown, given that it needed a $186 billion bailout to deal with what happened. So this is where the biggest concern is, if I'm addressing the question here, to make sure that as insurers consolidate, which they do, that they not be a risk to the financial stability because they could go down. And the last thing I would say on that is, despite AIG, AIG's insurance programs were never in jeopardy. It had to do with the holding company and its risks given its investments and guarantees. The actual insurance companies below that apparently were never in any sort of financial jeopardy, and those did not need bailouts. They were well capitalized and were able to meet all their policyholder obligations. I hope that answers that question for the audience.
Thank you, Professor. I want to switch gears a bit. Technology is advancing rapidly. You spoke a little bit earlier about AI, among other things. What features of our now 79-year-old regulatory framework, in your view, have allowed it to keep pace with the new technologies that have come to the fore?
Well, automation in all businesses. I also think, of course, the facility of communication that we've all lived with, which I think has been an important change with regard to the agency system. Go back to 1869, we had telegraphs, but not really a big use of that, I don't think. The agent in some rural part of a state needing to communicate with the insurer in another state was most likely going to take several days or weeks to get answers back and forth in the mail. So all of these changes have speeded things up quite a bit and removed a lot of the tedium of some of the practices for underwriting, some of the practices for claims. I'm told that in claims for automobiles, you actually don't even have to have the adjuster go see the car. Many of the repair shops just have a video facility. They photograph everything and send it back, and it all gets decided just that way. In terms of underwriting, I know underwriters use things like Google Maps and Google satellite pictures to help them identify properties to insure and get a better picture of that. Otherwise, they would have to go out and look at these things or rely more upon the agent for that information. And AI is probably just going to, in the good sense, automate many more what are still tedious manual processes to underwrite and handle claims. There have been some glitches by some of the startup companies on this. We should expect there will be more glitches as we learn the technology and more efficiencies as it becomes more useful.
Appreciate your insight there, Professor. And as a quick follow-up, then, one would imagine your sense is, if I'm hearing correctly, that is it fair to say that the state regulatory framework is malleable enough, has been malleable enough, flexible enough to sort of keep pace with technological advances?
Yes, and I'll say, as evidence of that, look at how different states have been coming out with their own regulations. New York, Colorado, Alaska has come out, I think, with the first AI statute to deal with many of these problems. So we see a lot of initiative by the states, and as you read through the NAIC committee's reports and draft model laws, they seem to be really on top of a lot of things. Of course, one can have disagreements whether it's too slow or too fast on particular issues, but I'm not seeing many gaps in the things that I follow that somebody hasn't already jumped on.
Thank you, Professor. You spoke a bit earlier about some federal laws pertaining to insurance, and pardon me, recently the U.S. Supreme Court heard a major case on the power of federal agencies, Loper Bright Enterprises versus Raimondo, calling into question the Chevron doctrine, which in layman's terms holds that when a federal statute's ambiguous or perhaps silent, courts should defer to an agency's interpretation of that law, so long as it's reasonable. Some question whether a federal agency system will still exist after the court decides Loper Bright Enterprises. Curious to have you speak to that and its potential overlay with respect to insurance.
Well, that goes back to if the feds had taken over insurance under the U.S. versus Southeastern Underwriters Association case, that would all be in jeopardy if the Supreme Court now knocks out all agency authority to make legislative decisions. And so that concern that could happen at the federal level is not relevant to the state. It won't have any bearing upon that, although similar challenges might be made at each of the states as to their own regulatory authorities. I think we also go back to, and here we can focus on insurance, legislators don't always know enough about every line of business to write all the laws they need to. and thus the need for study and the need for whatever agency specialties would be involved in this. Now, they can bring that back to the legislature, as happens in insurance, and say, here's a model law that the NAIC has come with, or the ABA in other cases, such as corporations laws and trust laws. I think there's a real benefit to having specialists who know both sides, both the industry side and the consumer side, to try and get that balance right, and that balance will always change. So I think the risk of losing agency power at the state level, that would be directly applied to insurance had it been so regulated there. We'll see what that means at the state level later.
Thank you, Professor. Insurance is pervasive. Insurance companies are operating over state lines, as you pointed out. Yet, as you've discussed and as we've explored, we largely have a state-based system of regulation in our country. We have for decades. One that you've observed has worked well, by and large. For public policy makers with us today who are new to insurance, how would you summarize the advantages and benefits of our state-based system of insurance regulation? I think that may be an important takeaway for a number of members of our audience as you reflect upon the 79-year plus history.
So I think I would like to, instead of taking that as one big question, break that down into lines of insurance. I think if you're talking about life insurance, you're probably looking at similar types of things across the country. Mortality will vary depending upon your occupations, but there's probably nothing particularly local or regional that will change it that significantly. When you're talking about property casualty lines, I think things change a lot because of the different perils that we're insuring under property policies. And so the big hailstorms, convective windstorms that are tearing apart the Midwest and have been the largest loss in the past year or so, are less so a problem in the far west and the Northeast regions. So I think when you're looking at property casualty insurance, there may be some more benefits to being able to address the need for different rates and the different risk control processes and underwriting based upon natural catastrophes and natural hazards. Liability may be more uniform, although since liability is dependent upon state law for support, that may be more state-oriented. Of course, there's a lot of similarity state to state, but there still remain quite a few differences among state laws for different types of liability. When you get to health insurance, I think that may be a very different question, given the market concentration of health insurers and market concentration of medical providers through private equity, a subject that the FTC and the NAIC are looking at in their respective roles. So it may be there's so much national influence in that line that state-based regulation might be more open to considering whether that's the best way to go forward.
Thank you,
Any
Professor.
others you want to ask about? Title insurance, long-term care? We could break it out by many, many different lines.
I think your response hits the nail on the head for the purposes of today's discussion. I would like to ask for your thoughts and your insight in terms of where public policy makers who are joining us today and their colleagues can go to learn more if they want to explore and delve more deeply into our state-based system of insurance regulation and to learn more as well about the McCarran-Ferguson Act. Any suggestions there?
Oh, I could list 20 articles and a dozen books if people wanted to go through all of that. I think you'd find NAIC probably has some good information. I think NCOIL probably has some good information on their web pages. I think the brevity of the McCarran-Ferguson Act really allows an easy read for legislators, unlike many bills that we read are 1,000-page long. This is just really a couple of paragraphs, and even the most recent edition only added 2 sections to one statute. So I think that, in reading the 2 cases, or I should say one case, U.S. versus Southeastern Underwriters, will give you a lot of history on this. Now, there's a lot of stuff behind that, which is what I've tried to talk about here. I don't expect people would want to read that. That's what I've tried to convey here, that this simple idea of it was state-based, then it was going to be federal, and then flip back, was not such an easy decision. There was a lot of twists and turns on both sides before we got there. I can provide a list that you can have on your website of some recommended reading. Some articles I think are particularly easy and informative, if that helps.
That would be wonderful. Thank you, Professor. And a quick sort of follow-up to you. You mentioned the notion of perhaps reading the Southeastern decision. And one would imagine that having a look at the dissent in Southeastern would be instructive as well. Would you agree with that? I mean, that.
Oh, definitely. And as a lawyer, I'll tell you, the dissent is always the most interesting thing to read on any case. Oftentimes, when I'm reading a Supreme Court decision or other major decision, I'll read just what the decision is on the first part and go right to the dissent to know what I should be looking for more carefully as I read. But I think it was a very sensible dissent on that to raise the question of who was responsible to make that change. A question that continues to resonate in the role of the Supreme Court in overturning prior precedent. They get things wrong, and that's why they should overturn prior cases. And technology changes and business changes. So what was right in 1869 was no longer, if it was ever right, was no longer right by 1944.
Professor Hal Weston, thank you very much. We appreciate you sharing your insight and your expertise with our audience. A special thanks to Michelle Telford for her production assistance. And last but not least, we thank all of our attendees for joining us and for participating today. We remind you that we invite your feedback via survey, which you will receive. We thank you for taking a moment or two to share that. And a final reminder to let all know that this discussion has been recorded. It will, in the days ahead, be posted to our website at griffithfoundation.org. So we invite you to revisit any portions of the program that you'd like, and to make colleagues aware of the fact that it will indeed be available on our website. With that, I'm Frank Tomasello. Thank you for being with us, and I bid you a pleasant good afternoon.